Stock markets are volatile, and stock prices can drop suddenly due to a variety of reasons. Knowing why stocks have fallen and what to do about it is essential for any investor looking to protect their investments and make a profit in the long run. We will look at some of the common causes of falling stock prices, as well as strategies that investors can use to minimize losses and maximize profits even when stocks are on a downward trend. Causes of falling stock prices. The most common causes for falling stock prices are the following. 1. A decrease in earnings, which is caused by reduced demand, higher costs of production, or a loss of revenues due to competition. 2. A decrease in company value due to poor management or lackluster performance during the current fiscal year. 3. A drop-off in share value due to increased supply on the market and a decline in demand for stocks. 4. Inability to maintain growth due to a lack of demand or competitive pressures. 5. A decline in trading volume. Strategies for investors to use when stocks see a drop in their value. If a company's stocks see a drop, it can be difficult to know how best to respond. Investors may be able to use the following strategies when stock prices decrease. 1. Diversify investments among different sectors and industries by investing in both public and private markets, as well as different regions of the world. Diversify investments among different classes of securities. Invest in companies exhibiting special qualities or characteristics, i.e., attractive yield, low volatility. What are the four main principles of asset allocation? Asset allocation refers to the percentage split between liabilities and assets within an investment portfolio. Divvy up your resources across a range of investments, including stocks, bonds, and cash accounts. Assets should be diversified across asset classes according to risk tolerance and personal goal. Allocate assets to match a targeted retirement date, reducing risk and maximizing returns as the date gets closer. Invest with a long-term perspective and expect to be in the market for a decade or more. Invest only in the asset classes that meet your asset allocation guidelines. What is the difference between fixed income and equities? Fixed income investments are bonds, CDs, and other debt instruments that pay interest. Equities are stocks in publicly traded companies. 2. Investing only with companies that have an established track record of success. Investing your hard-earned money is one of the most important decisions you can make. Therefore, it is imperative to ensure that the company you are investing with has a track record of success and stability. This ensures that your investments are secure and will yield returns over time. Investment companies with established track records have proven strategies for managing their portfolios and mitigating risk, making them reliable partners in achieving your financial goals. Typically, investment companies have an established track record by having a long history. This can be as little as 10 years and up to 50 years or more. Investment companies with a less established track record should be approached with caution. They may not be reliable partners in achieving your financial goals for reasons such as poor performance, lack of transparency, or the possibility of fraud. 3. Research the company's financials before investing. Stock market crashes are when the prices of some or all major securities fall in a broad market downturn. The market may decline due to various factors, including unfavorable economic conditions, geopolitical tension, and changes in investor sentiment. Several methods are available for researching a potential investment opportunity. One is to contact the company's financial analyst by phone or email. Financial analysts work for brokerage firms that provide research on companies they manage investments in and often conduct conference calls with investors as well. Another is to search the internet for information on a company before deciding whether or not to invest in it. Many companies provide investor relations summaries on their websites, as well as information about the company's products and recent developments. This type of research can help determine whether or not the business is a sound investment. The main indicator of the market's health is to track the price history of an individual stock over time to see if there is any pattern in price movement before investing. The company's financials may provide useful insights into its current state and future prospects, so it is important to research them before investing. Stock markets can show prolonged bull markets and prolonged bear markets. In the stock market, stocks are traded on an exchange through brokers and other intermediaries that act as matching parties to buy and sell securities for customers. Stock market crashes are periods in which the prices of some or all securities fall in a broad market downturn. When this happens, it is known as a stock market crash. There is more than one way in which this can happen. The variations in how this can happen to include a long period of high volatility, which can force some investors to sell stocks when they become overvalued. This causes the market to fall rapidly, and only those with experience or knowledge of the stock market are able to buy at cheaper prices. Pockets of weakness in specific markets or sectors. These pockets may become oversold, causing a crash in one sector, or it could be that a time-sensitive investment is available for sale that has been priced incorrectly and will cause the market to crash once sold. An emergency situation such as an unexpected terrorist attack or natural disaster. Now let's talk about the bear market, a prolonged period of declining stock prices and a corresponding decline in spending that lasts over 6 months. Bull market, a prolonged period of increasing stock prices and rising spending that lasts over 6 months. An investment that is expected to gain money over the long term. Speculative investing. The buying or selling of a security based on the assumption that its value will increase in the near future. Inflation. An increase in prices due to an increase in demand for goods and services, which is caused by a growing economy. Thank you for watching.